Markets have covered a lot of ground in the first 7 months of 2025. The S&P 500 plunged more than 1,160 points between February and April, then rallied 1,400 points through late July. So where do things stand now? How is the Q2 earnings season shaping up? Which standout names keep standing out, and which former laggards might be ready for their day in the sun? I brought two of my favorite MoneyShow MoneyMasters Podcast guests back to talk about all of that and more. That includes why you shouldn't should your portfolio to death or diversify it to death either. Palantir earnings, a big Tesla price target, and the one surprising sector that may finally be showing signs of life, they're all in the mix too. My guests are Keith Fitz-Gerald, principal at Fitz-Gerald Group, and David Keller, president and chief strategist at Sierra Alpha Research. Gentlemen, welcome. Gentlemen, appreciate you taking some time out to chat here. Certainly a lot going on in these markets, a lot to talk about, so I'm going to dive right in. We've covered, a ridiculous amount of S&P points in the first 7.5 months of this year. I was looking back, and it was down around 1160 from the February highs to the April lows, and then up 1400 from there. We're still only about 7% up on the year, so I guess let's start big picture. We'll start with you, Keith. What are your thoughts on just, again, this crazy market action that's got us to a fairly decent year so far when you net it all out?
Well, I would respectfully take issue with the idea of crazy, and here's why, is the markets have quantitatively changed a lot over the last few years, last 5 years in particular, with the introduction of, zero DTE, the highly computerized nature of what's going on, the move towards 24-hour exchanges. What we're seeing is not abnormal in the scheme of things when it comes to volatility. We're seeing significant time compression, we're seeing whatever, but the volatility that we're experiencing is simply accelerated. It's always been there. We've just never seen it in 1 year, 1 week, even 1 hour. But that's very much the world we live in.
Got it. Dave, your thoughts on all the ground we've covered in the first 7-ish months or so of this year so far?
I mean, it's been a remarkable turn from, early April where situations looked incredibly dire. One thing I know Keith would probably agree with, the market has retraced 100% of every market correction going back in history. So big sell-offs usually end up meaning you have great companies at a discount. And I think we're learning that off of the April low. Honestly, though, I would say one of the key stories in 2025 is not just the strength in growth stocks in AI. It's the fact that gold, Bitcoin, silver, so many other non-US stocks, there are a lot of things that have done even better than large cap growth year to date and off the April lows. So I think it's been an advance in a number of different things. And it reminds me not to think as much about what you think the market should do, but focus on what the market is doing. There's strength out there in a lot of different places. It's not just in a narrow group of stocks at this point.
Well, and that's, if I may, Dave, you and I have talked about this, that is fundamentally where many investors go off the rails because they second guess, say, well, the market should be doing X when the markets are doing Y. Your job as an investor is to recognize Y and then make the appropriate decisions.
A former therapist called that shoulding all over yourself. Don't do that. Think about what the market should do. Focus on what the market is doing as we try to do.
We have to be very careful with our enunciation there. I like that. So let's talk about some of that ex-tech type strength that we've seen, and then we'll get to tech in particular. I mean, foreign markets over U.S., some of these other sectors like materials that have been very strong. I mean, do you think that's sort of a shorter term type trend, David, or do you think that that's something that really people need to be paying attention to for more than a few months or a couple quarters here?
Yeah, I mean, the reality is in 2025, non-US stocks have performed much stronger, right? And if you look at the, global developed markets, even global emerging markets, they've outperformed the S&P 500 by a decent amount year to date. A big part of that story is the weaker US dollar, and a lot of the policy decisions that have been made have been, dollar weakening, and that's not unexpected. And the reality is what it is. I think the bear case, or I think the expectation of why that should continue is that all the tariff discussion and the impact really hasn't been felt. The market overall has been incredibly resilient. If you told me going into, February, March, April, there's going to be a bunch of tariffs, it's going to most likely make things more expensive for people. Are companies going to thrive? And I would say probably not. But the market has priced in a lot of optimism. while there's certainly some skepticism that I've heard, sort of the bear case on it, the reality is the charts have not reflected that just yet. I think it goes back to our earlier discussion. I think the gravestone of a lot of unsuccessful investors will say, I bet on what I thought the market should do given XYZ. And the reality is focus on where the strength is. I see a lot of reason to be optimistic based on the performance of key assets. And as long as the trends continue higher, I'm going to want to follow that as long as possible. We want to remain in an uptrend, which the market generally is at this point.
Keith, I want to drill down to a couple of specific earnings reports in a minute, but first I just want to ask you about, in general, your thoughts on Q2 earnings. I mean, what are you hearing out there? What are you seeing? What do you think it sort of means for the markets here moving forward?
Well, it means very much the same old thing that we've talked about, but with a different spin. You've got to invest in quality. You've got to be in to win. And finally, you've got to absolutely bet on where the world's going, not the world that's been, right? And, David and I were joshing each other in, I think it was Dallas, when I was one of those folks who sat there during the worst of the April low and said, you know what, this is the time to buy. You definitely have got to be in if you're going to go play this game seriously. And, so to me, again, I've been doing this a very, very long time. People talk about what they see in the history books. I tend to have lived it and made tea time after that. So, the one thing that many investors can't model or can't come to terms with is behavior and intuition. And those things are still very viable investment strategies in today's market. So I'm going to look forward. I think the earnings have been exactly what they expected, or I expected, which is much stronger. But the market is increasingly splitting. You've got to go with the best companies if you want to be at the top of the game. Otherwise, just, going back to the woodshed, roll your dice and call it good. But I'm going to play to win. I'm going to play with the best names I can buy, and I'm going to do it all day long.
Dave, I want to ask you one question before I zero in a few of those names. I looked at some fact set numbers, and the one thing that I see, if there's a fly in the ointment when it comes to the earnings picture, is that positive surprises are being kind of met with a participation trophy, and the negative surprises are being met with a kick in the teeth. They looked at their, the percentage gain on positive surprises being just 0.9%, I think, and on the losses about 5.5% down, which is worse than the average. So any thoughts on people, not really buying good news, but maybe selling bad news more aggressively?
No, I think that's an interesting point. And I would say the earnings around Microsoft and Meta, I think, were most telling last week, right? So you had they both reported after the close on Wednesday. Meta and Microsoft both gapped higher. By Friday, at the end of the day, both had rotated, to the lows of that 2-day period. Now, obviously, we had the jobs report that came out on Friday, which ended up being pretty significant for a lot of investors, I think reasonably so. But when great companies report solid earnings, and then the gap higher is sold, which is what we saw, that's where I think you start to see some signs for concern. Now, having said that, Meta is still at or near all-time highs for all intents and purposes. It really has not broken down, and it's remaining above that breakout point, which is why I would say to Keith's observation, I think the strong names continue to get stronger. If you look at the performance in 2025 on a sector perspective, it's relatively narrow in terms of the number of sectors that have actually outperformed consistently. I mean, at this point, if you look at, at recent months, technology by far the positive outlier, industrials probably a second one, and now utilities starting to improve a little bit. The rest of the S&P sectors have pretty much underperformed the S&P and the NASDAQ in 2025. So I think, remaining with stocks in a position of strength, demonstrating accumulation, which I think they're out there. I think that's the game right here.
Well,
Keith,
but I mean,
I'm gonna throw Palantir to you here. I mean, that's obviously been a name you've pounded the table on for quite some time, and we're talking about spectacular earnings. I mean, what are your thoughts on what we just saw from them?
Well, before I get to that, I want to hone in on something here to David's point, right? Is we've had roughly 2/3 of the S&P 500 report to date. 82% have beaten EPS, 79% have beaten revenue. So the nature of the surprise is very real and it's very there. And that's the part that people can't grasp, right? So if you're gonna have a rising tide raising all boats, you got to focus on what's actually out there and what's actually winning. And there are names out there. There are stocks, great stocks that are being accumulated because they continue to put up the markets. We call this a still market, Mike, meaning that people still don't believe what's happening. Institutions are still on the wrong side of the trade. The Fed still doesn't have a clue what it's doing. And on top of that, the greatest companies are still putting up numbers. So yes, you still want to be investing. I mean, kind of see what I did there. But anyway, bottom line is, Palantir is one of those companies, right? It's a company that people still can't grasp. It does not have any real viable competition. It is doing the unthinkable. It is redefining ontology and learning language models. There is no other company that enjoys the kind of customer support, contractual longevity, and depth that it does. So I think this company is not only running to 200, a number that I put on board when it cracked 100, but I've been on board with this one, and I've been very fortunate since $10 range. So, this is going to continue to go. It's going to be one of the great names in history. These are companies that are rare, 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 rare. So when you see one as an investor, it is your job to get on board, latch on, and hang on for dear life, because you've got an opportunity to do something really unique with your money.
I got to bring up another name you've talked about that actually has had some hair on its numbers, and that's Tesla. But you actually, I saw your one bar ahead cover. You called it the math from undervalued to unstoppable. What's your message on a name like Tesla?
Well, this is another stock that, the greatest stocks in history are also often, ironically, the most controversial. So, Jobs was incredibly controversial leader. Apple, people forget, it was almost bankrupt 3 times. Amazon lost 97% of its value during the late 1990s, early 2000s, as part of the dot-com crash. It was so bad that Bezos had to go around and reassure everybody the numbers really would work. But if you look at Tesla, people constantly talk about Tesla, cars this, cars that, cars that. They are completely missing the boat. We're talking energy, we're talking charging, we're talking robotics, we're talking AI, we're talking silicon production, we're talking redefining storage, mobility, human labor economics. Cars are going to be a decreasing percentage of overall revenue within the next 3, 4, 5, 10 years. It is entirely possible that Tesla can make more per car in the next few years than conventional automakers make in 10 cars in 10 years, because you can change a few lines of code and add billions of dollars to the top and bottom line. So I'm very content with this position. I hope I own more shares. I'm smart enough to pick up more shares, but I have no problem holding this one. I think it's going to run to $600 and then some within the next few years.
Okay. Dave, I want to ask you, you highlighted a biotech of all sectors recently as maybe being sort of perennial underperformer, but looks like it might be getting things together. Is that still the case? And if not biotech, what else are you maybe seeing that's on that sort of contrarian spin?
Yeah, I mean, I think I mean, it's funny. I think between the two of us, I think I'm the bear out of the two of us, Keith, which is fine. I think that's for someone has to play that role. I mean, for biotech in particular,
I would respectfully push back and say you're not a bear. You're prudent and you're cautious, and that's why you're successful.
A cautious optimist, we'll call it that.
Yes.
No,
but you always have a
would say,
smile
yeah,
on your face.
I would,
That's what optimists do when they invest.
You're right. You're right. I would say with biotech in particular, the healthcare story has been pretty underwhelming, right? And particularly on a relative basis. I'm a big fan of relative strength, which is why I mean, as much as I see great companies doing great things, I also see a big segment of the market underperforming the S&P and the Nasdaq, and that's just because the biggest names keep getting bigger and doing well, and their oversized impact means a lot of other things are gonna start to underperform. So it's challenging if you start, stock picking in the wrong places in some of these sectors. So while I would say healthcare is an area that I think it's tough to justify on a relative basis, there are sort of opportunities, not just in healthcare, but I would say within consumer staples. I could identify some random, tobacco names have looked pretty good at times. So there are opportunities, and I would say biotech in particular, the IBB, which is a biotechnology ETF, recently getting back above its 200-day moving average. I'm seeing that sort of rotation on areas of the market that have been kind of chronic underperformers starting to improve. So in my opinion, I'm a big fan of sort of technical diversification. Would I sell a chart like Palantir because it's quote unquote overvalued? I wouldn't, because I think as a trend follower, you can always argue stocks feel overvalued when they're in a heavy growth phase, which it appears to be. It's in a clear uptrend phase. I think that's justifiable from a technical perspective. But I would also say I wouldn't want to put all my chips into that particular theme. I would be looking for other opportunities that have been underperforming that are starting to improve. And I think biotech maybe fits into one of those groups from a technical perspective, underperforming for quite some time, starting to show signs of accumulation. And I think probably taking what has maybe become an oversized bet for a lot of investors in some of those mega cap growth stocks, maybe rotating into some other areas that have been underperforming but starting to show strength, just makes sense in terms of diversification in the equity space.
Any thoughts on, to talk about stuff that's really been running versus things that have been underperforming? I mean, some of these sort of non-stock assets, things like gold and of course the mining sector that follows that. Thoughts on how far, that's come? We've seen sort of broadening out from just gold to silver, some of these other metals. Is that something that is interesting to you, or do you think it's another case of too far, too fast?
I'm a big fan of that. If I would start, I'm a big fan of charts that look good. I sign off all of my videos with it's always a good time to own good charts, and I truly believe that. So, whether or not you think gold is ridiculous to justify at whatever level, when the chart is constructive, you should be following that and dedicating part of your assets to that. I think what benefits gold over the long time, it's tended to hold up as a pretty good store of value. It's tended to hold up as a pretty good inflation hedge. It also has tended to, be a good return diversifier away from equities, right? The general correlation is pretty fluid, meaning regardless of what happens with equities, gold often kind of charts its own course, pun intended. So I would say from a technical perspective, the long-term trends on silver and gold quite strong. In the short term, you've seen gold kind of stabilize and be in a consolidation phase. So I still have a decent position in things like the GLD and the IAU, more physical gold. But I would say things like gold miners, like Newmont Mining, has actually been a remarkably strong chart. So I think miners in particular may be a bit of a catch-up trade to the strength in gold and silver.
Yeah. Keith, I know you've talked in some of your presentations at Money Shows about really, not over diversifying, focus on those big winners, take a narrower approach, I guess, but know that these are the real winners. Anything outside of some of the names we've mentioned that, or maybe outside of tech that looks interesting to you and sort of fits that bill?
Well, there's lots of things. I mean, we invest heavily in the healthcare space. We look at biotech. We look at everything. But, we're opportunistic and we're driven by, buy the best, ignore the rest. So if we're looking at a stock like that, it's not because it's in a specific sector or because it's undervalued given, its relative performance or something else. We're looking at it because we identified it as a potential winner. And it's got some sort of 0 to 1 catalyst as opposed to an N+1 catalyst. An N+1, for the distinction of viewers, is it's just a better mousetrap. It's putting an iPad on a bike, a la Peloton. That's not a must-have company. That's a nice to have, and it's not a business model. But if you look at a company like Apple, for example, making must-have devices the world can't live without, now you're talking about something very different because every time they introduce something, they change the game. So that's the kind of scenario that we look for. So, our names, yes, are all over the map. But again, we are focused very, very specifically on companies that we believe are going to have tremendous upside and have that liquidity that needed to push substantially higher over time, almost irrespective of what the markets do.
All right. So hiring Sydney Sweeney is not a catalyst for that kind of change, right?
Well, I'm not familiar with that whole jeans article thing, but I haven't seen the commercials. I get it. I mean, I understand whatever controversy there is, but no, that to me, if you're going to invest, you've got to make a constant series of decisions. How much is this going to pay off versus that? So a lot of the companies people talk about, they say, oh, this is a good name and that's a bad name. I say, what are you talking about? This could be a good name, that can be a good name. The question is, which one do you think is going to double? Because if you have an opportunity, you reasonably can identify the one that's going to double. Why are you going to invest in the one that's going to go up 5%? I don't play for the diversification. That's like rearranging the deck chairs on the Titanic. And in my opinion, quantitatively, because we've proved it, that a theory has held investors back for 10 to 15 years. The problem is people don't own enough of the right stocks, the big movers. So they get all bent out of shape when they own an ETF that is broadly distributed and they don't get the kind of returns that a Palantir generates. Well, the answer to that is buy some more Palantir, keep your ETF, and refocus your efforts.
Yeah. Well, you guys are both going to be joining us for the 25 Money Show Traders Expo in Orlando in October. So really looking forward to that. I know it's a couple months away, so it's always tough to say, but just briefly for anybody watching this, what are they going to, get out of your presentation there? What kind of message are you going to share? And I guess I'll just start with you, Keith.
Well, I'm going to say, everybody look at Dave, tell what Dave's doing, and he's the smart one. But seriously, I do attend Dave's presentations because I do. But what I'm going to talk about is how do you get set up into 2026 and what it's going to take to get ahead and stay there.
Dave, same question to you. Any thoughts on what you think we'll be covering or kind of what your message is going to be for investors there?
I think the timing of this event in Orlando is going to be fantastic in October. I mean, one thing we haven't talked about is the seasonality in the market. As much as I think there's a lot of reasons why the market could go higher for sure, we're entering in a period of the year, particularly in a post-election year, which tends to be kind of weak. August into September. September has almost always been a negative month. In this sort of year. So I think most likely, I don't have a crystal ball as much as I would like to sometimes, but I wouldn't be surprised if we're in a period of short-term weakness going into that event. And I think that'll be a really good opportunity if you have cash to deploy to think about where you want to sort of be making your bets between there and year end for success in Q4 and into the next year. For me, it's all about routines. So we'll certainly talk about the tools and techniques you go through every day, every week, every month to reinforce and identify strength, so you don't find a great idea after it's already had a ridiculous run. Let's find things earlier on in that uptrend phase.
Well
Perfect.
said.
Perfect. Well, gentlemen, thanks again for your insights. I appreciate you taking some time out here. Viewers, if you're watching this, you definitely don't want to miss out on what Keith and David have to say. That Money Show conference is going to be in Orlando, October 16th to 18th. You can find more details in the description below, and a link you can click on if you want to join us. Thanks again, and we'll just have to see what happens in these potentially weak months. But once we get through it, hopefully a strong finish to the year.